here. Today we're going to be talking about tax deductions, the commonly misunderstood, and hopefully I'll bust through some myths for you all. So this will be a good one. I have a lot here today. I was writing down my notes just to make sure that I stay on point, and I came out with two full pages of notes here. Uh, yeah, so this is real here. And it's not even like all of the tax deductions that I could have addressed. I picked out some common ones that I get questions on all the time. So hopefully this is helpful to you all. As you all know, if you've been sticking with me all week, or over the last couple 2 weeks, you know that I have been discussing tax planning because now is the perfect time to be tax planning. We're a little over half of the year, so it's enough data that's come in for you to look at your situation and to kind of see if there's a room for tax saving opportunities. So that's why I've really been honing in on tax planning lately. All right. So I have a 6-part framework that I've been using and that I am sharing with you all so that you can use to look at your tax returns to see if you got some room for improvement. Already I've discussed, we're about halfway through, so I'll briefly go over that framework again for you here. So step one would have been to look at the entity structure that your business is using, kind of evaluate if that's still serving you well or if it's costing you money. Step number two was accounting methods. We're talking about step three today, which is tax maximizing your tax deductions. And this isn't the first day. We talked about it on Monday. We're talking about it today. And I'm also going to be addressing some red flags on Friday and some advanced tax strategies or loopholes. Step four is going to be maximizing tax credits or incentives. And then we're going to be looking at retirement planning and advanced strategies and loopholes. So if you've missed the first 3 steps, right, you can go back to my IGTV and review those. I also have a master class that is almost about an hour long that goes over each step and also some tax planning saving opportunities for you. And that master class is also on my IGTV. Hello to everyone coming in and joining. Thank you for being with me, taking some time. Hopefully you take away some things that is helpful to you. If you guys have any questions or comments, please feel free to drop them in the comments below. If you are shy, feel free to also send me a DM and we can connect that way. All right. I do want to remind you all that my free tax strategy session is still available. I do still have some slots left for August, but I do encourage you to go ahead and book that because they're filling up fast. Now you can find that link to schedule your free tax strategy session with me. The link is in my bio. Okay. It's going to be the second link in my bio. The first link is the freebie that I have available to you all. And it's a cheat sheet of the framework that I just laid out for you. It's going to be your 6-part tax planning framework. You can take that cheat sheet, keep it in your business, use that this year and years to come to review your tax return to see if you have any tax saving opportunities you can take advantage of. Hello, everyone that's joining. Okay, so I'm going to get right into it. It is almost 4:30 my time. I'm in Illinois, so I'm on Central Time. Wherever you are, either you're going into dinner, maybe you're just thinking about it because you know it's coming up, but I'm going to get into this. So, some common misunderstanding. I always hear clients talk about tax deduction, tax deduction, tax deduction. What deductions can I take? What can I deduct? Deduct, deduct, deduct. And they're good. Tax deductions are a great way to save money on taxes. I rarely hear business owners talk about tax credits. Tax credits are superior to tax deductions. Why is that? Because you save money with tax credits dollar for dollar, right? If you get a credit for $5,000, your tax bill goes down $5,000. Sonny, you're asking me where that cheat sheet is. My apologies. I am multi-streaming on Facebook, Instagram, and YouTube. So, Sonny, you're on Facebook. You should have a link to that freebie in the caption to this broadcast. If you don't see it now, you'll see it shortly after we end. Okay. If not, you can hit me up, DM me. I'll send it right to you. For Instagram, you have links in my bio. Facebook and YouTube, you have links in the caption. Okay, so back to tax credits. They're far superior than tax deductions because you save money dollar for dollar. Now, a tax deduction, you save money depending on your tax rate. For example, let's say you have a tax deduction for $100 and your tax rate is 20%. You're only going to save 20% of $100, which is $20. Now, if you had a $100 tax credit, that lowers your bill by the amount of the credit. So you save on your taxes by $100. I hope that cleared everything up. Tax deductions, again, they're important, especially the ones that don't require a cash outlay. And what I mean by that is depreciation, for example. You can get major tax deductions from using depreciation. But you don't really spend, there's not really a cash outlay for you, right? It's kind of like phantom menaces. It doesn't really affect current cash basis. So while you get a benefit in that year, but it didn't necessarily affect cash in that year. Now, at some point it did, right? It's all timing. It's all timing. But you didn't have to go spend a ton of money to get a benefit in that year. So the point is, don't forget about tax credits. Everybody rave about tax deductions. Keep your eye out for them. Keep your eye out for those credits as well, because 9 times out of 10, you have to have done something in your business to qualify for the credit. All right, so let's go on to the next misunderstanding. This is another one I get a bunch of questions about. IRS audits. Every time someone's audited, they think they did something wrong. They think they're in major trouble. They're going to jail. No, you're not going to jail. IRS audits are random. Now, when right out my career started with the IRS, I spent 8 years as an IRS auditor. So it was me knocking on the doors of businesses and business owners saying, hey, we're auditing you. I didn't literally knock on doors. I called them usually, but I didn't knock on their door. But I did audit people, right? So don't be nervous or anxious or overwhelmed by an audit. It doesn't mean that you did anything wrong. And I would advise you not to manage your audit like you did something wrong, like you're nervous, because you're going to send signals and presumptions of guilt if you do that. If I was an auditor auditing you and you came in there real shifty, nervous, I'm going to think you did something too. Just know IRS audits are random. They are random for the most part. They are completely random. It's like jury duty. It was just your turn, okay? Your chances of being audited. Everybody always asks me that. Am I gonna get audited? What are my chances? Very slim to none, right? So there's 350 million people in the US right now. Let's just assume half of those people are tax-paying adult, working or business owning or investing adults. The IRS only audits less than 1% of those people. So the chances of it being you are very, very small. Very, very small. However, do not use what I'm saying as a reason or an excuse not to have your ducks in a row. Still have your substantiation your records, your documents in place to prove everything you did on that tax return. I have an IGT episode that I did maybe about a month ago before the tax deadline in July about reconstructing documents. If you do your tax return, you find that you lost a receipt or you don't have all the substantiating document. And what I mean by that is just records that prove you incurred an expense related to your business that you feel you can deduct on your taxes. If you don't have that, you lost that, there is tax law that supports that you can recreate those documents and it be admissible in audit to support the tax deduction. Go back on my IGTV. It's in the 7 Steps to Slay Your Taxes series. Look at that. Use that as guidance to reconstruct whatever you're missing and keep it on file. In the case that your audit, again, chances are low, but at least you'll be ready if you are audited. Now I'm going to get into 3 very specific deductions that are always misunderstood when it comes to business owners. Okay, specifically beauty entrepreneurs. And if you have any questions, like I said, as I'm going through this, drop them in the comments, or if you want to discuss something a little further, DM me or book a call, because it'll get a little, I'm going to try not to be too technical. All right. So the first one is startup expenses. And these are going to be for the new beauty entrepreneurs out there. Okay. Startup expenses are like, okay, so you are thinking about starting a business. You're looking into it. You are investigating or researching the creation of your business. And so you're going to incur some costs for that. A lot of people are confused on what you can take as a deduction and when you can take it. And I want to just clear that up, okay? You can deduct startup or organization expenses up to $5,000 each. So there's 2 buckets, startup and organizations. Your startup expenses are going to be the expenses that you incur that are related to the research, the investigation expenses, the exploration expenses that you incur when you're thinking of starting a business. Now, this cannot be just a hunch, like, I think I should start a business. This is like, you want to, but you gotta make sure it's feasible. Any expenses you incur in that process is going to be a tax deductible startup expense, and you can deduct it up to $5,000. Your organization expenses. This is expenses where you're like, yep, I know I'm going to start a business. So I need to register with my state, my Secretary of State. I need to get my LLC. I need to get my partnership. I need to get my corporation together. I need to get my registered agent. I need to put together my partnership operating agreement or my corporation bylaws. Those expenses that you incur goes into the organizational cost bucket, and you can deduct up to $5,000. Now that comes with, of course, an exception. If those expenses in total exceed $50,000, your $5,000 deduction will decrease by the amount that they exceed 50 grand. Now, I haven't seen a case where those expenses exceed 50 grand for small businesses, but in case they do, your $5,000 current deduction will go down. If you have over $5,000, you can take up to 5 grand. Anything over that, you have to capitalize, and you can deduct over 15 years. That is the rule. Okay. Now, you cannot deduct these until you open your doors, until you are available to either sell your product or provide your service. If you're not ready and your business hasn't started, sit on that. Sit on those records and those expenses, those receipts. Keep that in your file. Soon as you open those doors, that's the year you can take it on your tax return. A lot of people are confused about the timing and what you can take, and hopefully I just clarified that. If not, go ahead and drop a question or a comment or book a call with me so we can kind of sort that out. A lot of people don't take startup expenses. They just think because they don't have a business or because the business at the time they incurred the expense wasn't open, that they don't take it. No, still take it. Take the expense. Sometimes they don't take it because the expense may run a loss. That's okay. Losses carry over. Let's say, for example, you're starting your business as a side hustle, you're still working your 9 to 5. If you start your business and you take the startup and you run a loss because you didn't make any money your first year, which is very common for new small businesses, it's fine. You can take that loss and net it against your other income, which can be from your 9 to 5. Now let's bust the myth right now. Will you get audited for that? No, you will not get audited for that. There are not a lot of things that is going to flag an audit, not in it of itself. Now, taking a loss against your 9 to 5, would it make an auditor think? It probably would. However, if it's legit, still take the loss because it's explainable. Is it out of the ordinary for a new small business to run a loss their first year? No, it's very common. And if you can show that to the auditor, you're all good. Long as you have your ducks in a row and your documents to prove it, you're all good. It goes back to don't be afraid that you're being audited. On paper, it looks weird and it's fine. And if you get audited and they have questions, you have the proof to show that it's legit. Okay? I could go so deep into when you have a side hustle, new business, run a loss, netting it against other income. And I will probably have a separate broadcast for that because that is a real thing, right? But I can coach you through how to handle that. Don't not take your loss because it can be audited. Still take your loss, still save your money, still get your money, your benefit from this. That's literally your taxpayer right. Okay. All right. Besides the side hustle, besides you netting the loss against a W-2, let's say you have no other income. And let's say your new business, you take these startup costs, you run a loss because you didn't make any money your first year. Fine. Your loss will carry over. So your next year, when you open and popping and making money, you now have an NOL deduction from the year before when you didn't make any money. That'll lower your tax bill. Boom, you save money the subsequent year. Hopefully I cleared that up, okay? All right, let's go into the next issue. Meals. People always ask me, oh, if I have if I treat a client out, is that deductible? If I treat out if I'm courting a prospective client or a prospective business partner, maybe even investor, is that deductible? Absolutely. I'm going to clear this up though. The new tax law that was passed maybe 18 months ago, it abolished entertainment. So back in the day, you could take a client out to a bar game or some type of entertaining night and deduct the whole day or night. No more. You cannot do that. Entertainment is gone. Is it questionable what entertainment is? No, it's not questionable. You know if it's entertainment or not, right? A ball game, a Broadway show or play, sometimes strip club. Strip club is entertainment. Okay? No more entertainment. Only meals are deductible, and they are not deductible 100%. You only get half. You only get 50%. Now, let me clear this up. Let me clarify this for you. If you still take your client out somewhere, Or let's say you have it at the spa or salon or whatever your brick and mortar space is, and you bring in entertainment. But you also have food. As long as you can carve out the cost from that night between entertainment and food, you can still take the cost of the food by 50%. Just make sure when you get a receipt from your caterer or your event planner, or if you go to a ball game or a facility where there's both food and entertainment, just make sure on that invoice or that receipt, they carve out the cost of the food so you can take 50% of it. Okay? The cost for your meals for your employees at your workspace, at your workplace, used to be deductible. It is no longer deductible. Not even at 50%. So this is like places that had cafes, cafeterias. They used to get deducted. No more. Not even in the break room. Okay. Now, if you have the annual holiday party, you have the annual summer picnic, you have the annual, well, we didn't have that this year, right? Pandemic. But in other years, right? We'll be better next year. Maybe we'll be better this winter, right? And we'll have annual holiday events in person without needing a mask and social distancing. You can still take those things 50%. Remember, if you bring somebody in there to entertain, you cannot take that. You cannot deduct the cost of the entertainer. You can deduct 50% of that food. A lot of people ask me, can I tax deduct wine and liquor? Of course. Yes, you can. Yes. Yes. You lemonade, water, tea, liquor, coffee, all of that. You take 50% of that. Now, while you're traveling, right? You and your employees are traveling. Let's say you're going to a cosmetology trade show. 50% of all of those meals. On your way, while you're there, on your way back. When you get home, 50% is over. Okay? Now, here's the highlight, right? Here's the highlight of this discussion about meals. Let's say you have a spa salon open house because you're trying to get new clientele. Pandemic is over, right? Across the country, pandemic is over. Stay-at-home orders are lifted. Everything is back to normal. And you want to get your client base back up. You have an open house and you have a nice spread. So this is open to the public. This is for you, your employees, and anyone off the street that want to come in and check you out. 100% deductible. 100%. Because it is open to the general public. Now, I hope it was a lot of misunderstanding about all of that. So if you got questions, let me know. But I hope I've given you some good guidance on meals. Okay, we got two more. Home office deduction. Now, I don't know where this myth came from that if you take the home office deduction, you are going to get audited because no one works from home. I think we just proved that wrong, right? Because everybody working from home right now. If you can. I even know that some of you, I don't know what your state says about this, but some of you are doing procedures at your home if you can. I have been to someone's home during the pandemic, okay? I've been to someone's home for my hair, my eyebrows during this pandemic here. So I know people are working from home, and for some reason people think you work from home, you got a home office or home workspace, that is, you're gonna get audited. That is not a fact. There is not one issue in and of itself that you're gonna get audited for. You got to take these issues in proper context, right? Normally, if someone is taking the home office deduction, right, and they're also a W-2 employee where they have an office or a cube at some major corporation's campus, and they're taking the home office deduction to do the very thing that they have a W-2 for, that's a red flag. Because you can go somewhere and work. Okay, maybe not during the pandemic, but you can go somewhere and work during normal times. Believe it or not, even during this pandemic, even W-2 employees who are forced to work from home during this time, even they still can't take the home office deduction. So that's the red flag. But if you are a business owner, right? Even if you are a W-2 employee and you have a side business, you can take the home office deduction. You totally can. And a lot of people miss out on it because they are scared of the IRS. I was the IRS. And do I look scary? I'm not scary. I'm a person. At the end of the day, IRS are ran by people. So don't be scared of the IRS. Even the IRS gets it wrong. Okay? Take the home office deduction. Now, there are two ways to the home office deduction. There is a safe harbor, which is a very easy way of computing your home office deduction, right? So take you can go into the office or the space that you use. That's another misunderstanding. People think that you have to have a room as an office, and you don't. It can literally be a space within a larger room. As long as you use it regularly and exclusively for your work, that can qualify as your workspace. So don't think just because you can't dedicate an entire room for your exclusive and regular use for your business activity that you can't take home office. You totally can take home office, even if you just have a space. So what I want you to do is I want you to measure the space, right? Take that number and divide that, take the square footage and divide that by the entire area of your home. And that's going to be like your business use percentage. Okay, keep that in mind, right? So when you're doing the safe harbor, that's the easiest way. You're going to take the total space, multiply by $5. And then that's your home office deduction. There's a cap on that, but that's an easy way to take the home office. Now, then there's like the regular way. You take all of your direct and indirect expenses of your home office space. I'm going to use that so you don't think you have to have a room. You're going to take your direct expenses, right? So let's say you bought some specialty carpeting just for your space. It's not all over the house, just in your space. Take the entire amount of that cost. Let's say you need special lighting for your space. I do. It's just special lighting that I love for my workspace. But it's not all over the house. Take the entire cost of that. If you got some special furniture, you got this specific desk, this specific chair, these monitors all over the place, whatever you need for what you need to do your job, that's just in that space, directly to that space. Take the 100% of that cost. Then you got indirect costs, right? So you have your mortgage or your rent, your property taxes, you have your utilities, you have, the cooling system, all of that. Those are indirect costs. Total those costs up, apply them to your business use percentage. Total up direct and indirect, boom, that's your home office deduction. And that could be a pretty penny, okay? Now, one clarification I want to just use to just clarify. The home office deduction will not give you more of a loss. If you are already in the red in your business, it won't give you more of a loss. What it'll do is it'll roll over. So that's one thing I want to just clarify for everybody. Don't not take the deduction because you're already in a loss, because you can use it next year. So let's say you're not in the red next year. You actually made money. You have net income. You can take that year's home office and you can take last year's that you couldn't take because you were in the red. So keep up with home office. Now there is, when you're a Schedule C, when you're a sole proprietor or an LLC, single member LLC, it's very easy. You just take this on the Schedule C, it rolls through on your 1040. But it gets a little complicated when you're a corporation. When you are a partnership or you're an S Corp or a C Corp, you can't just take home office as easily as you did when you were a sole proprietor or a single member LLC. Because you won't even, you can look at those tax returns, you'll realize there isn't even a line for home office deduction. That's because now you and your business are two separate entities, right? And your business can't just go paying for your personal stuff. Now, I bet you're thinking like, well, my home office deduction isn't personal, it's for the business. You're right. And so the way you're going to do that is you're going to have your business reimburse you for the costs you're incurring for keeping a space in your home to work. And you have to have what they call an accountable reimbursement plan in place. And this is where tax planning comes in. See, because that's something now, that's an implementation step you need to take to ensure that you can be reimbursed for the cost of keeping up with a space within your home to work. If you want to talk more about that, schedule some time with me. Click that second link in my bio to schedule some time with me. And we can see just how much you can save by having your business reimburse you if you are a partnership or a corporation. You should not be having your business just pay the cost. You got to have something, you got to have documentation in place within your business for your business to, one, take it as a deduction, two, for you to get reimbursed for the money, and three, for you not to be taxed on that reimbursement. One thing I do want you to keep in mind with the home office, very important, is not a red flag. Take it. If you're not taking it, you're overpaying in taxes. You're leaving money on the table. Number two, it doesn't have to be an office per se. It could be a space. And it could be more than one space. Let's say you have a room that you, with a desk that you do your administrative. Then let's say somewhere else in the office, you have a table where folks can come over and lay to have a procedure done. And then let's say you got a closet where you're storing product or equipment. Add up all that space. That's all used for work in your home. Take all that space and all the costs associated with that space as a home office deduction and see how much that adds up to. Okay, I can go on for quite some time on home office, but I'll stop there. Okay. All right. So the last one I got for you guys is business driving expenses. Okay. And there are two areas of misunderstanding about business driving expenses. Number one, you got to keep good records. That's like, got to be like top 5, top 3 of areas that business owners do not keep good records is mileage. This area to save money on taxes is solely driven on whether you kept records on the miles you're driving. There are two ways for you there's two ways for you to compute the tax deduction for using your vehicle for business. They are both reliant on how many miles you drove. So you got to keep mileage records. And they have very good apps and technology to help you do that. The top one that I hear about is Mile IQ. I rarely drive for business, so I haven't personally used it, but Mile IQ is what a lot of my clients use to track their miles. Got to track your miles. Like I mentioned before, can you reconstruct records? To prove mileage? Yeah, you can. You can. But that'd be difficult to remember how many miles you drove. And if you were to get audited, I mean, there's some skepticism there. Are you really remembering the miles you drove from a year or two ago? If you're audited, it's ridiculous what we'll ask for to prove it. We'll say something like, okay, go get me a receipt from when you got an oil change in January of last year, and then give me a receipt from when you got an oil change in December, because you know when you get an oil change or a car repair, they take a note of your mileage. That's ridiculous. Like, what car? I mean, you could, but I mean, it's a hassle. So just keep records on your miles. If you use your car regularly to go get supplies or equipment, or go to visit clients, or for whatever reason go to different work sites, because I know some of you may have more than one salon or spa location, or if you're doing deliveries, just keep up. Use MileIQ. Look into that. There are two ways to compute your business driving deduction. Okay. You can do the IRS's standard mileage method, where you just take the miles you drove, you multiply by the rate, and it changes every year, and boom, you have a deduction. Or you can take actual expenses. Now, a common misconception is that you can flip back and forth. You cannot. You cannot flip back and forth from year to year between the methods. If you start your business and you pick actual, gotta stay actual. Now, if you pick mileage, you can switch to actual, but you can't do it the other way. Cannot. What I would say to you is, before you think about switching, do the analysis beforehand. Which way are you better off? I can say I have clients with very expensive vehicles. They have very expensive cars. So for those folks with luxury vehicles, your Benz, your BMWs, your Audis, your Infinitis, the upper echelon, the European vehicle, the Tesla, all of that, go actual, because you're going to come out on top from depreciation alone. But if you're normal like me, I just have a Buick Regal and I love it. Go ride her till the wheels fall off. Go mileage. Okay. All right. Now, for you, if you're leaving money on the table every year, if anything is resonating with you from what we just spoke about for the last 40 minutes, go to that second link in my bio, book your free tax strategy session with me. Let me explain just briefly what that looks like, okay? Once you click that button and you pick your preferred date and time, it's going to be 30-minute session. Before our session, though, I'm going to ask that you answer a few brief questions about you and your business, and I'm going to ask for a copy of your tax return. Now, I know how it is. If you need to redact or black out your personal information, I feel you. Do that if that's what makes you comfortable. But I'm going to ask that you provide that to me, because I'm going to spend some time and I'm going to review your turn, so that when we meet, when our session comes up, I can tell you exactly, yes, this is how much you are probably, it's going to be an estimate, of course, but it's going to be a very good estimate. This is how much you're leaving on the table. This is how much you are overpaying taxes. And if we move forward with tax planning, this is how much, I'll tell you how much you can save in the current year and for years to come. Now, if you're shy and you're not ready, and I get it, and the first link in my bio, I have a freebie where I am going to give you a cheat sheet that you can use to review your own tax return. And that is going to go over the tax planning framework that I use, which is I look at entity structures, accounting methods, maximizing tax deductions, maximizing tax credits and incentives, retirement planning, and advanced tax planning strategies and loopholes. And then after you get your cheat sheet, you are going to have questions, and then book your call with me at that time. My August books are open. The slots are filling up fast because I opened them a couple weeks ago, but they are open, and book a slot and a time if it's available. I'm going to be going back into the second tax season come September, so I'm going to get a little busier. Books won't be open as much, but August is a great time to do this, guys. So if you have any questions or comment, now is the time to do that. I've been holding you guys long enough. If you are shy, feel free to DM me now or later, and we can connect and we can kind of discuss whatever you like pertaining to tax planning. But if not, I'm gonna sign out, guys. On Friday, I am still talking about tax deductions because I mean it is very important because it's one of the simplest ways to save money on taxes because it's money that you're spending already to run and maintain your business. So on Friday, we are going to be talking about red flags. Now, everybody's interested. Oh, what's a red flag? What's a red flag? I'm going to go through red flags. They often change. And I'm going to go over a couple of advanced, juicy tax strategies. Real juicy here. So plan for that. I'll, of course, send out like a flyer post to remind you of Friday's topic and time. But if there are no questions or comments, I'm going to let you all go. Have a great rest of your evening, and I hope to see and speak to you on Friday. We're going to be wrapping up tax deductions before the weekend starts, guys. So thank you again for joining, and I will talk to you soon.